Hello everyone, Courtney and Jonathan here today from the USAA Educational Foundation. And yes, Jonathan, because I missed it, but also to make a point, happy birthday.
Thank you very much.
Not right now. So, how old are you? In days, because I want to make it tricky.
I have no idea. And even if I did, what exactly does this have to do with investing strategies, which is what we're supposed to be talking about today?
Hang with me, Jonathan. I promise it'll make sense in a minute. I know it's a crazy question. I mean, you'd probably answer in years instead of days, right?
Well, sure. Years definitely makes more sense. Can't say I know anyone who expresses their age in days. So yeah, crazy question.
Well, that's the same kind of crazy that people use when they measure their investment performance in days, weeks, or even months instead of years or decades.
I get it now. When it comes to investing, you need the right perspective. Nice.
See, I told you I had a point to make.
And it was a great one. That ties directly to today's topic of using well-established approaches to build an investment strategy. Since you kicked us off with that one, I'll take the next one, which is to diversify. Now, to get right to the point, don't put all your eggs in one basket. If you put all your money into a single investment or just a few, and they don't perform well, you could be in trouble. Instead, consider spreading out your risk.
That's actually a great segue to our next tip, which is to avoid chasing returns. But what does that even mean? Chasing returns means you are only focused on investing in the biggest gainers. And this chart can help explain why that's usually not a good idea. What you see here is the performance of certain asset classes from highest to lowest over the last 6 years. Notice any patterns? If you don't see one, you're right. There is no pattern. In fact, some of the best performers one year are among the worst performers the next year. So you see why chasing returns can be a bad idea.
Now, our last tip is to dollar cost average when investing your money. And it's my turn to take a slight but very connected tangent to make a point. Now, when you go shopping, which you do a lot, you'd rather buy something on sale than at full price, right?
Well, it's smarter.
Clearance rack all the way for you. Well, it's the same with investing. But the problem is no one knows when the market will drop or go on sale. So it's pretty difficult to time the market and jump in at the perfect moment.
Well, that makes sense to me.
And that's why it's a smart idea to dollar cost average, where you buy a fixed dollar amount of the investment you want on a regular schedule, regardless of the share price at the time. You'll buy more shares when the price is lower, less shares when the price is higher, and you won't have to second guess whether now is the right time to buy.
Who wants to make guesses when you're talking about money? To bring everything together, the market is always going to move up, down, and sideways, and there's no way to know in advance when it will do any of those things, or how much it will when it does.
That's right. And remember, with investing, there are never any guarantees. That said, building an investment strategy that incorporates these tips we just covered can give you a better chance to succeed. So until next time, where's my cupcake?
1 second.